start. It's a good start. We are marching towards 19,600 now. 19,500 has been conquered, so it's a good start. The breath, I think, is looking charged up. We've got Max Financials, Block Service, block deal is done. Coforge, the block deal is done. But Power Space, I think there is a block deal in Manappuram Finance also. I can see it on my screen. But in terms of a theme, I think it's back to power. BHEL, Ratan, India Power, Suzlon, Reliance Power, and then you got JP Power Ventures. Folks, just be careful here. Just because it's power does not mean everything is great. Power at 440 is high voltage. It will burn you. So just be slightly more careful here in terms of looking at the stocks here. But in terms of a powerful mover, let's look at Reliance. Why Reliance? Well, the deal has happened in terms of a retail inclusion, and it's not moving the needle thought as much. Jio Financial Services, the pre-open rate was telling us it will be down. Is it circuit down and the markets have opened? Yes, it's circuit down. 213 rupees. Bit of a mystery. A lot of retail guys have been texting us trying to understand what is happening. We'll have a detailed discussion sooner than later. But for the moment, Reliance is flat and Jio Financial Services is another circuit down.
Yeah, another circuit down, and if it continues this way, then there could be a further deferment of its ouster from the index and the adjustment thereof. Reliance, though, has a soft floor after that QIA deal. Let's see which way the stock actually heads from here, because, I mean, clearly with the kind of valuation that QIA has come in, it's almost 2x the retail part of the business that is in about 3 years' time. HAL is the other one which is in focus. LCA Tejas has now successfully test-fired Astra air-to-air missiles, so that's one stock we're looking out for. There's Vascon Engineering as well, which has got a letter of acceptance worth about 605 odd crore rupees. Torrent Pharma, besides all the buzz around them picking up the promoter stake in Cipla, there's also US FDA, which is classified the Dahej unit as a VIA now versus the OIA status earlier. There's Atul Auto as well, wherein Society Generale has bought about 1.4 lakh shares. That's almost equating to about 0.7% equity in yesterday's trading session. Atul Auto will just come up for you on your screens next. And then Snowman as well, wherein the promoter Gateway Distriparks has bought about 11 lakh shares in a block yesterday. Both those stocks are holding up as we speak right now. Sentiment negative for both ONGC as well as Oil India, considering WTI is now sub the $80 per barrel mark. Crude has slipped sub 83. So look out for these names. And then Sun Pharma, wherein the US Court of Appeals has ruled against the company in one of their patent litigation. So that's another stock in focus. And I just want to revisit what Coforge is up to, because sources are indicating that Bearing PE is looking to sell the entire 26.6% stake. So that's another stock holding up 3% right now as we speak. Let's also chase some of the big movers from yesterday. And remember, it was banks to the rescue in yesterday's trading session. So Federal Bank, RBL, Axis, ICICI Bank, SBI, all of them held high. And today as well, you can see that trend continue. Net result, the Nifty has had a comfortable start above that 19,500 print. Naresh, the key question is, are we going to latch on to 19,500, and is the strength in banks going to support that?
So expecting Bank Nifty to go towards the 45,000, 45,200 mark, and Nifty towards 19,600. And then we'll see it next week if we see a follow-up. We have the US event. So we'll see on Monday if we can again go beyond that. But for now, have a view of 19,600 and 45,000, 45,200.
So Naresh, what are the first trades that you're punching in?
So like Bandhan Bank, that remains a reversal candidate which has done well, expecting it to slowly go towards 260, 270 levels.
All right. Rahul Chadha joins us, and I don't have to look straight because he's not joining us on from Hong Kong or from his office. He's joining us from our studio. Welcome to India.
Thank you.
What brings you here?
So there was a...
Everybody has the same question. Can you imagine?
Chandrayaan 3?
yeah. I mean, there was an investor conference early this week, and we came for that. And then this was a time to meet companies, meet the policymakers here. And I must say, it's been a good couple of weeks here in India.
Navigating the traffic.
Sorry.
I was stuck in this. We've had rains. There were times I was at a signal for 30 minutes complaining to my wife. But that's it.
So what's the buzz you're picking up from the conference? Is the sentiment for India at an all-time peak?
I think if we sit back and reflect on it, clearly in terms of macro policy, and this is from New Delhi, we are way much better than what we've done in the previous decades. And this is coming at a time when globally policy making is kind of deteriorated. So when you compare relatively, we may be a standard, 2 standard deviation above rest of our peers. And I think that is what is somewhere giving support to this market, that when you talk to the senior policy makers, they're very clear that they're willing to sacrifice near-term growth for the macroeconomic health of the country, etc. And I think things are on control. We've had strong execution on the infrastructure projects. The GST collections have been fairly robust. So somewhere that kind of provides a flow to the growth, that provides a flow to the market in this period of uncertainty. From corporate India, I think the feedback's been mixed. Banks is as good as ever. There are pockets which are doing exceedingly well, hotels, travel, etc. But consumption, particularly from retail perspective, is weak, and nobody is able to point a finger at what is the reason. Is it that the consumer is in shell because of inflation, etc.? But yeah, consumption's been a bit weaker.
But if that is the case, then why the banks are showing growth in the retail book?
So I think this is a question we all are asking. Is it unsecured loans? And to be fair, if you ask me, what worries me is this growth in unsecured loans over last 5-7 years. And now everybody is kind of complacent about it. So one thing which would worry me about banks, and this is a space we've liked, is, look, are we going to see some of the delinquencies come through in unsecured loans? There seems to be a kind of an complacent attitude about it. We've seen RBI also come and talk about it. Hopefully regulators tighten more norms on this, but this would be a thing to watch for.
So do you go selective in banks? Do you partial profit take here, or do you add more to your portfolio?
So absolutely, the approach here is you go with conservative banks. You want to go with banks who've got strong underwriting franchises. You want to go with banks who have a strong liability franchise, but one would go conservative in the financial space here.
You know, it's been quite a deviation from the pharma space with what we saw during COVID time, pre-COVID, etc. What's the outlook currently on pharma, particularly with the expensive valuations?
So if you see pharma space, the rally happened from late May, June, when there was this buzz that, look, pricing in US has improved. One thing which we guys have to watch out for over the next 6-9 months is the strong deflationary impulse coming from China. See, demand's kind of been very weak post this reopening. We've seen renminbi come under pressure as China writes a blank check for the property developers, local governments, etc. And our belief is that renminbi further weakens from here. As renminbi weakens from here, the Chinese corporates see less demand at home. A lot of that material is going to come in the export markets. So pharma story looks good for next couple of quarters, but beyond that, I would be watchful, more so in terms of deflation, which is coming from China.
You did speak about, consumption as being a bit of a weak link, and some of the inflationary concerns as well persisting. So what does one do then when it comes to the consumption space as a whole? What's the advice?
I think the idea here is to buy on dips. Right now, one would be more predisposed towards consumer staples. They've got pricing power. And with this deflationary impulse which is coming, their RM costs will go down. We've already seen that in the last quarter. They've had 3 to 4 percentage points gross margin increase. The hope is ahead of the election, government gives some sops, and you will see some demand momentum pick up. Discretionary, I think, is going to be long drawn recovery. May take more than what it takes for staples, but staples over discretionary here.
Okay. So you're picking a spots in consumer discretionary. That would include autos also?
Yeah, so if you look at discretionary, there would be pockets which are doing well. I mean, and we own that in our portfolio. Examples would be hotels, hotels, something like a Zomato, which has been doing exceedingly well, and there's a World Cup, and I think that's it there. And autos, see, there are autos.
You can also buy Jubilant Food Works. Huh? People order a lot of pizza when World Cup matches are on.
yeah, but Zomato gives them option for other things. But yeah,
do you think this time they'll order biryani?
People like options. People like options.
As they always do.
Exactly.
That's the most ordered dish.
Yeah.
But since you are closer to the mainland, I want to talk about the China factor, because in all the conversations that we've had is that India is a relative outperformer and a relative preferred bet. But relative to what is the question? And when you stack it up against China, a lot of concerns and a lot of push coming in from the government. Wanted to understand from you whether it's really working on ground.
See, I think what we've got to realize is, and this is the government is trying its best. So unlike 12 months back, where the policy making in China left a lot to be desired. We are having a policy bazooka from the government, but somehow the underlying response from the consumer is just not there. And for that, we've got to go back to history and see. And whenever excesses happen, they take their own sweet time to digest. So China needs 4-5 years to digest the excesses of the last decade. So it's going to take its own sweet time to recover, come back, etc. And I think that is what most investors are realizing. That look, in India also we are seeing a slowdown, and there is no denying on that. But this is not a structural slowdown. It's just a temporary slowdown. Give it a couple of quarters, the consumer comes back and he's going to spend on these discretionary products. And I think that's the differentiator between the two economies.
Does one need to be exceedingly selective when it comes to looking at new age tech as a space?
Absolutely. So I think that's what we've done. You would like to go with companies obviously who are disruptive. You'd like to go with companies who are frugal about using the cash flows. You'd like to go with businesses that have a great connect with the consumer. And hopefully in the shocks which come every 6-9 months in the market, you get an entry price. See, your entry valuations are also very important, and it's very important for us to differentiate between a good company and a good stock or a good investment. So we do that with real estate, we do that with other things. Unfortunately, what happened because of the decade of cheap money which was in 2010s, people forgot this, and that's why people lost a lot of money. Yeah.
So you're not looking at buying power, PSUs, defense, aerospace, those are the hot sectors.
So see, we run a ESG fund. In the ESG fund, obviously defense or some of these coal mining or thermal stocks are constrained. But look, the fund's done well, and there are so many opportunities outside that. But to your question on power, I think for the first time in June, we saw those power shortages come in. And if the economy grows like this, that is going to be there. So the idea is to look at select power stocks which have a sizable renewable component also.
Let us ask you what you're buying. Tell me what you're selling.
What are we selling? See, in this market, again, what we were selling was some of these expensive mid caps. I think the risk reward is just not favorable over there. There's been a lot of exuberance on inflation peaking, consequently rates coming down very quickly, and this is something we've discussed before. Yes. Market is going to be disappointed on that. So I think our policymakers are very clear that rates come down when US cuts rates, and the differential is the lowest it's been in years, and this is where market would be disappointed by the stickiness of the rates and the growth recovery in small mid caps. And if you're looking at some of these small mid caps which are exporters, I think the pricing pressure from China would become all the more noticeable in coming quarters.
Are there any pockets of undervaluation right now in the market, or is it all froth?
I wouldn't call everything is froth in the market. Look, if you look at financials at the valuation they are, and I would call Indian private banks as the fintech giants of the region, they're fairly cheap compared to what fintech is valued. So I think there are pockets which are reasonably valued. Parts of autos are reasonably valued. Expensiveness is basically in small mid caps. But look, the longer term growth tailwinds for the economy are so strong that one would be a buyer on these tips. So there would be kind of an cyclical downturns, which would be 2, 3, 4 quarter downturns, which are small cyclical downturns in a long structural stories, and that's where we'll get good entry points for these stocks.
So let me divide your portfolio into two categories: 1 to 3, 5 plus. What would you like to own for 1 to 3? When I say time frame, 1 to 3 time years and 5 year plus.
Okay, let me make it from a medium term time frame, which is 3 to 5 years plus. We continue to like real estate. See, this is something we bought. Real estate. We aggressively bought post COVID. Our point was there's a 10-year downturn in the sector, and affordability the best it's been. You look at the new household creation, people want these, the market's consolidated. So I would still go back and buy real estate from a 3-5 year time frame. We continue to like hospitals as a space. That is something which has done well. We've been anchor investors in the likes of Narayana, etc., Haridwar, etc., and continue to stay committed to that space. QSR is a space we like. If you look at China, something like a KFC. KFC has 8,000 to 9,000 stores. I mean, in India, you look at similar formats, it's a fraction of that. So these are the names apart from obviously the financials we have. From a shorter term time frame, I think our view is as renminbi slips, rupee would also slip. So won't be surprised to see rupee between 85, 87 over the next 6-9 months. So some of the exporters would benefit. So something like a pharma, something like IT services would benefit. Consumer staples could be good place to hide and
Why
protect.
consumer staples?
Consumer staples would be good place to hide and protect your capital, basically, because it's an uncertain environment. Market would correct, discretionary would be under pressure. So that's more from a defensive perspective. So that's to answer your question on what to do from a near-term 1-year perspective. But as one gets the confidence that rate cuts are happening, growth is accelerating, then you go back to those longer-term structure stories.
I'm just thinking about it that the only defensive trade in this market is that don't buy defense stocks. And some of these space stocks have gone as if, from...
They themselves are making a moon landing.
Yeah, I mean, from moon, forget moon, I think they're prepared, they're giving you valuations of Mars. So strange things are happening in that space, right? Defense, space,
So
government
people like
PSUs.
us who've been in market long enough,
How many years you've been?
So I started my career in July 99. So 24 years now. Wow. So I saw the tech cycle. So I saw the frenzy where fund managers used to sell Wipro in 2003 circuits forward, because Wipro was part of benchmark.
It was not liquid.
It was not liquid. So we've seen that. We saw the infrastructure boom, where you had the likes of IVRCL,
Reliance Power issue got subscribed in 60 seconds.
Yeah.
Reliance Power issue got subscribed in 60 seconds of opening, and it was a 7,000 crore IPO in 2008. Add inflation back up, it will be bigger than 25,000 today.
Yeah. So I think we've seen that again. And look, it's very important to preserve capital. You will get opportunity to make money. And if you look at most of the retail participants, I think that's a concern I have. They like playing in derivatives, FNO, that gives them the bang for the buck. They are levered on that. Okay.
Yeah,
I think we need smart anchors like you guys to help them here. That's the only thing I'll say.
Yeah, we need smart advice from you. But since you have tracked IT for so long, tell me what's happening with IT. I mean, what is the real picture right now? There is all that AI threat, the slowdown in the sector, companies coming out, cutting their guidance, talking about weak visibility for the next 2 to 3 quarters. Is now the time to buy them?
Okay. So what's happening in IT is clearly your discretionary spends have slowed down considerably. But at the same time, your large, $1 billion, $2 billion cost out deals are happening. So somewhere these deals are coming through. See, the corporates are saying, look, there's an opportunity for us to look and revisit our processes, and that's where these large deals are happening. So these large deals take their own sweet time to ramp up, and that is where you see the volatility in the earnings. Because of this Gen AI, what happens is the pressure on whatever subcontracting costs they had, on the employee costs they had, would be considerably lower. The Gen AI gets truly commercialized, accepted by the clients in 3-4 years when they see the prototypes, proof of concepts, etc. So till that time, it's a window of opportunity for smart companies. That can they create a 100,000 workforce which is competent in Gen AI and do it faster than the global majors, and they capture this opportunity. See, these companies have captured the opportunity post Y2K. They captured the opportunity post cloud. It is all about being nimble and creating a large trained workforce in the technologies of future.
So who could do that?
I think the bellwethers, the likes of Infosys, TCS are well positioned to do it. Yeah. Of course, there's smart younger companies also, mid-cap companies also. But there's a lot of good talent in the sector.
Yeah, they seem to be embracing this opportunity quite well. What about sectors that are undervalued in the markets currently?
So honestly, one's got to think very hard to find something which is undervalued. Look, it's a well-discovered market. I think financials, large private banks, or to an extent somewhere, the large caps which have underperformed are where one would take some money out of mid-small caps. To Nikunj's earlier question, that's what we've been doing, to take money from small caps, mid caps, and put it in large caps. So
I go back to that basic template of IT, and something which we are debating and discussing with everybody. Let me divide the IT space into two: bread and butter business and the AI business. The AI business is disruptive or not disruptive, I don't know. Only time will tell us. But then there is a bread and butter business which is slowing down. So one leg of the business is up, one leg of the business is down. It's like a seesaw, right? In that seesaw, how much long do you think markets will take to price them? Because terminal values will change.
See, what happens here is, look, the slowdown's been evident for last couple of quarters. It came with Infy's kind of a reduction in guidance in April.
Like somebody dropped a bomb.
Yeah, so it happened, and to be fair, on ground it started happening for these guys from March onwards, basically. So somewhere the sector is also underowned. So the price momentum in the sector has not been as much as other spaces. And look, these companies been around for 25 years. So we've got to give them some respect for being able to navigate the different ups and downs of the business cycles. The free cash flow yields are good. They are good capital allocators. So I think market will give them benefit of doubt here.
What about super specialized IT companies? We've never had this kind of a range in India, whether it's in MapMyIndia or to some extent InfoEdge, some extent I would say Latent. There are a lot of these specialized SaaS-based companies which are now getting created. You like that space?
So honestly, we've not done much work on those companies. They are the likes of KPIT, etc., which comes specifically on that. Valuations kind of inexpensive. So one's been watching that, but one needs to get more conviction because these are very usually a single vertical company. You're not aware of the disruption which is going to happen to them. So there's a fair bit of a volatility or inherent risk in the business model, and you're not adequately compensated for that in terms of the valuation. See, the valuations are not 15, 20 times. The valuation for most of these guys would be 45, 50 times plus. Yeah.
Which is the hottest sell side idea right now, and which is the hottest buy side conviction idea right now?
See, I don't really look at this. You look at the sell side for the inputs which come through, but I've never really worked on the hottest sell side.
You sent everybody, they whispers, which you pick up after the conference. We've been attending so many of them, and you come back and you say, that was the number one idea at this conference. You may act, you may not act. That's
I think what came out was people were fairly interested in hotels. That's a category which is doing well, and clearly there has been a huge amount of underinvestment in the sector, similar to real estate. You've seen demand momentum pick up, economic momentum pick up. So I think that's a good space for next couple of years.
I was entertaining a guest 2 days ago at one hotel. And 2 cups of cappuccino costed me 700 rupees.
You're a rich
pricing
man.
power or inflation, I don't know. But that's why you have to pay for a cup of coffee, good hotel. Can I get you in coffee?
Not from the canteen. Pleasure having you in our studios. Thank you so much for coming by and sharing with us your insights.
Thanks for having me, guys. Thank you.
Thank you very much.
All right, that's the take. Looking at QSR as a theme, hotels, hospitals, select autos. Those are some of the themes that are appealing. Just a quick check-in as to what the index is up to and holding out around the 19,500 mark in trade. But time to shift gears then, and it's five-star business. It has been a recent listing and there's been nothing but pretty strong growth that we've seen. But is there threat now from rising competition? Will the asset quality trends remain intact? All of that will be answered by Shrikant Gopalakrishnan, who's the CFO of the company. Good to have you on board, and as I said at the start, it has been pretty strong growth for you so far. You've revised your guidance upward to 35%. So what kind of market opportunity do you believe can yet be tapped, and how do you plan to capture that?
Good morning to all, and thank you for having me on the show. The market opportunity for this segment continues to remain, extremely robust. And, one of the studies that we had given in the DRHP is that, the market opportunity for this is 22 trillion Indian rupees. And we operate predominantly in the tier 3 to tier 6 kind of towns, where, people don't have access to formal finance. These are small businesses, self-employed individuals who don't have documentary proofs of their incomes by which, they can go to the larger NBFCs or the banks to avail funding. So given that if we have the right kind of infrastructure to tap these people, because we believe, while, there are a lot of other NBFCs who are continuing to tap into this space, we believe the biggest competition for us comes from the unorganized sector or the money lenders, who are like, thousands and lakhs in our country. If we are able to displace them and give these borrowers, better interest rates, give these borrowers more organized finance, give them the opportunity to amortize the loan on a monthly basis through an EMI mechanism, give them good protection for the collateral that they give to us. And these are people who are going to graduate from money lenders to institutions like Five Star. So that presents a huge opportunity. Whether it's 22 trillion, 20 trillion, or we can keep debating till the cows come home. But the opportunity in front of us is immense. And today, Five Star as an institution has built the infrastructure to actually go and tap into this segment. As we speak, we have more than 400 branches across 8-9 states of this country, predominantly in South. So once you have an infrastructure, you have the ability to reach out to these customers, you have the ability to underwrite these customers, underwrite their cash flows and give the loan, and are able to have the right collections infrastructure to ensure that your asset quality stays robust. I would think the opportunity is extremely immense, and which is one of the important reasons that we revised our growth guidance from 30% to 35% in the recent past. So we are very confident of growing at that pace, given the opportunity and the strong infrastructure that the company has built.
But what kind of runway do you have from the existing capital, or would you need to raise more?
See, this is a very tricky question, I would say, especially if you have looked at our numbers. We are not even leveraged 2:1. Our debt equity is 1:1. So, and we have also been an extremely profitable company. We continue to, for example, last year we clocked a profit of 600 crores. We will continue to 600 plus. We will continue to keep improving on this profitability. So that's also going to get added to the net worth. So the intent today is not even to look at capital for the next few years, so which is very good from the shareholders' perspective. There are going to be no dilutions. The intent clearly is to increase the debt, which will definitely be benefit to the shareholders in the form of better return on equity. So we have a very long runway. Our debt equity is 1:1. We had a net worth of about 4,500 crores, which will continue to keep growing up. Now, let's say even if this number goes to 5,000 to 6,000 crores in the next 2 years or so, and looking at a leverage of a debt equity of about 3:1 from there, the maths is very clear for all of us. You're talking about 20 plus thousand crores that we can very easily grow with the kind of capital that we have.
There are a lot of P investors in your company. Some are selling, some are buying. Is that independently of what's happening in the business? I mean, you don't bother about what's happening there?
So, Nikunj, I would not be able to say that, we don't bother about what's happening there. Obviously, some of these things are going to have some bit of, murmurs in the market and all that. What we try and do is we ensure that, there is a coordinated effort on the part of the sellers to actually, offload their stake whenever they want liquidity. So obviously, I can't expect them to stay invested forever. But at the same time, investors have also seen the benefit of compounding over the last many years. The good part is these are not investors who have been invested with us for 12 months, 24 months. Like Matrix Partners came in 2014 and 15. So that's almost like close to a decade that they have stayed invested. Even the largest investor like TPG has been with us for now, I would say 6 years or so, 6, 7 years, 5, 6 years. So very clearly they understand that their actions are going to have some impact on the markets. And it is also important from their perspective to ensure that there is a good coordinated effort. And whenever they have to offload their stake in the market, it is also important for them as well as the company to bring in the right set of investors. So obviously, there is a coordinated effort. We will try and do what we can to bring in the demand for the supply that they may have from the right set of investors. So you will see supplies coming through. Nothing that we are aware of to come in the near term. But yeah, you will see supplies coming through. But we are also very confident that we will get the right set of investors, like what we call as the long-only investors or the sovereign funds, to come and pick up these stakes. As long as we are able to
you'll appreciate the spirit of my question, because there's a large investor who's looking at unwinding their positions, and they have a large investment in Five-Star, that's Sequoia. So my question perhaps was specific to that, because when we speak to some market participants and folks who track your company, your stock, they said that is a big overhang. So I just wanted to get your perspective on that.
So, Nikunj, exactly the point that I was making. It will be perceived as an overhang, but the comfort that we can give, especially, since you have taken the name of Sequoia, is also the fact that Sequoia is also one of the entities of Sequoia, which holds close to about 9% or so, has been tagged as a promoter in the IPO. So they have also locked in a portion of their shares. So that portion of the shares is locked in for 18 months, which is at least about roughly a year from now. So I don't think, the risk that the market perceives is as big as what they are perceiving. Obviously, like I said, there will be, supplies coming in at points of time. We are in constant touch with all the investors, and, we will help them, or we will facilitate a right kind of I wouldn't call it as an exit, but right kind of a sell strategy for them, by which, they are able to optimize their returns, and the company and the public shareholders also don't suffer. So the intent is to bring the right set of investors and, ensure that we have a match in demand and supply. See, beyond that, I think, if we are of the firm belief that these investors have been associated with us for a long time, and they're not going to do anything that will be to the detriment of the company.
My next question is on your NIMs. They're fantastic, and some would say they're enviable, and everybody is keen to understand that how long can you sustain this kind of a spread as you grow? Because right now the book is small. When it will grow, can you sustain this kind of a spread?
So let me just break the question into two parts, Nikunj. One is the spread and one is the NIM. We have been guiding this, over the last about 3-4 quarters when we've been doing the investor calls and interacting with the media. Our steady state expectation on the spread is about 12 to 13%. See, today we are lending at around 24% or so. Our borrowing cost has sharply dropped despite what the market has seen, 250 basis points increase in the repo over the last about 12 to 15 months. We have actually seen just 50 basis points increase in our cost of funds. So our costlier borrowings have been replaced with cheaper borrowings, which means our spreads have actually gone up. The NIMs are inflated today because of the lower debt to equity. So today, while you see NIMs at around 17 to 18%, I would say these are not, I wouldn't use the word sustainable, but these are not realistic because this has an inflated capital base. Once the leverage starts increasing, we will surely, see the NIMs falling down to more like 14-15%. So our guidance has always been that we will continue to hold the spreads at about 12 to 13%. Today, they are also a little bit inflated. I think the markets, interest rates in the markets are sort of getting to a point where we will be able to reasonably predict that it will either stay at the similar levels or it will probably start, dropping. Which means, we'll also pass on some of these benefits to our borrowers. So the spreads will drop, the NIMs will drop. But having said that, I think what the market or the shareholders will expect from us is, while we are at about 16-17% ROE today, at an ROA of 8% and a leverage of 2x, if we are able to increase this leverage, let's say to about 3.5 to 4x, obviously there will be a constriction in the ROA, which will probably drop to about 6-6.5 in the steady state scenario. But that essentially means you're looking at a north of 20% ROE, which is extremely attractive for the investors. So that's the journey that the company is embarking on to create, very good wealth and a long-term value for the shareholders.
Okay. Aditya, great to have you on the show today. Shrikant, I beg your pardon. Good speaking with you as always. Let's move on. Let's talk about what's happening within the sugar sector because in a major development, India may actually be looking at banning sugar exports for the first time in 7 years. So let's try and understand this move a little bit better. We have with us Aditya Jhunjhunwala, the president at ISMA, joining in on the show right now. Aditya, hi, morning. Good to have you on the show. A ban on India's sugar exports, Aditya, after a gap of about 7 years. What could be the implications for the sector? Because this is definitely going to lead to price escalation.
Morning. I would like to say there is no ban on the sugar currently. And nor the government is thinking, nor the industry is asking for that. If you see our numbers at ISMA, we are saying the production we presume is approximately 317 lakh tons. And which will be enough for our domestic consumption as well as there will be a surplus of 4 million tons. So we are still looking at the final numbers which we will be getting in the end of September, and accordingly we'll be requesting the government to take a call on the same.
So are you telling us that there is no official intimation from government that they are looking at banning sugar exports? You confirming that to us?
Yes, absolutely that.
Is it in the works? Is it in the works? Do you think something is coming?
No, I don't think so that's happening because now the government and the industry all together, we will be looking at the final numbers of the crop. And that will be knowing only after by maybe mid of October or maybe end of September. So once we know the exact numbers and we know exactly what the crop is looking like, then accordingly the government will take a call on the same.
How understanding was, and not just us, but many reports are indicating that because of the diminished cane yield caused by insufficient rainfall, this move could actually take place. Give us an understanding on how the crop output has been, the yield.
So as ISMA, we have done our satellite mapping in the month of June, and accordingly we have taken out a press release, and the numbers what we feel is approximately after diversion of 45 lakh tons of sugar to ethanol, there will be still a production of sugar approximately 370 lakh tons. And if you see the domestic consumption is in the level of approximately 275 lakh tons. So there would be a surplus of 4 million tons. So that is the preliminary estimate what ISMA has taken out. And subject to the correction, because seeing the rainfall in August and September, we'll be coming out with the final numbers in the end of September again.
One of the reasons why there could be export ban for consideration is largely because of what is happening to the underlying prices. Can you walk us through where the sugar prices have moved?
So if you see, the international prices are approximately at $700 today, which is approximately 60 rupees a quintal, a kg. And if you see in the neighboring countries, the prices are hovering around 80 to 90 rupees. And we in India, like the current prices, the XML prices are ranging between 36 to 37 rupees. So we are well below the international price range. And if you see, it's at the same level, despite there has been increase in FRP last year, plus the cost of the repo rate has gone up, the inflation has gone up. Still the prices are at very, very reasonable level or below.
The festival season is round the corner. When you say that there is enough supply and enough stock available, are you factoring in an uptick which will also come because of Diwali, Dussehra and Ganpati demand?
Yeah, that's a normal phenomenon that happens every year. If you see, whenever there is a festive season, the government releases little more quota on the market, and that's a normal phenomenon. It happens every year. And as I said, there is no dearth of sugar. We have a sufficient stock. And we emphasize that end of this year, the crushing season, when we have take a sugar season, there will be a stock approximately 6 million tons.
So there'll be enough for export quotas as well, that you're saying, for the upcoming festive season, right?
So there are two things. What ISMA we feel is, first we have to look at our domestic consumers, and then we have to go for ethanol program, and third priority will be export. So if you see the numbers, if we see the production after diversion of ethanol is 317 lakh tons, and our domestic consumption is 275 lakh tons, so there will be a surplus of 4 million tons. That is the preliminary estimate. Then we have to look into what is the final numbers we think about, and what will be the closing stock. And if you see, in the last 3-4 years, the government and the industry has been on a number which is approximately 6 million as a closing stock.
If there is a ban on exports, if we're speculating right now, we heard it's coming, your view it's not come, so I'll go by what your view is. What could be the incremental impact on the profitability of existing companies which are exporting to the market? I mean, how much of the industry currently, as percentage of the total sugar is exported?
I think it's a hypothetical question as of now. I think there will be, depending upon the final numbers. So whatever the surplus would be, there has to be an outlet for the surplus. Either there will be more diversion to ethanol or will be an export.
What was your last communication on this from government? I'm asking basic questions because what we have with us and versus what you're telling us, there is a mismatch. So I hope you'll appreciate the spirit of my question.
Yeah. So we have been communicating with every week, maybe, or every 10 days with the government. And I think the view of the government is aligned with our views that we need to take a call after the discussion when we know the exact crop condition. And that will be by end of September or maybe in October. And then we'll request the government.
Aditya, really appreciate your time and thank you for joining us. Well, what do we have on the market? Well, okay, Adani stocks are bouncing back. They are limping back, if I may say so, but they had fallen 2 to 5% on an average. So they are really limping back to normalcy. Profit booking could happen because of a lot of factors which are at play. Pharma is holding on smartly. Hotel is where the uptrend continues. Banks are the one which are mustering a lot of strength. And Nifty now is at, well, not bad at all. What, 25 points more, you go past 19,600. Maybe we'll get Kunal inside to talk about the importance of this combination of Reliance and Bank Nifty and Nifty. Are we in for that breakout trade? If you're in for breakout trade, That means a range which in a sense has not haunted us but has dominated the market. The whole view that okay, we are not headed up, we are not headed lower, we are not headed anywhere because markets are in the range. Looks like we could be in for a decisive breakout on the upside. It's becoming increasingly difficult to call which way the breakout will happen, but you go above these levels, according to technical experts, the breakout may happen on the upside. It may well be the case, Aisha. I mean, you got suddenly, the range will change if situation changes, and situation has changed on the global front, on the local front, on the flow front, and also some would say on the technical front if you go past 19,600.
Yeah, let's keep our fingers crossed and see where we actually headed from here. For now, we've made it to 19,500 for sure, 582 in fact, and cruising along quite smartly. But it's these smaller penny stocks now, Nikunj, which have actually begun their move up. That's getting a little bit scary.
You got to be careful, Aisha. But
Yeah.
what see, you live and learn, and the realization for me has been that may be one indicator, but not the truism that okay, just because penny stocks have gone higher, these stocks will markets will drop out. Look, there's a section in the market where you got to be careful, and just because the tail is wagging the dog, that does not mean the market will peak out. These are patterns which we've seen historically, but historically the understanding, the technology, the communication, the media presence, the WhatsApp groups, all of them were so different that just because penny stocks have gone higher does not mean markets have peaked. One. Second, the penny stock movement I think is frothy in a lot of groups, not universally. So power stocks are there, where a lot of these penny stocks have started going up. A lot of defense stocks. I mean, it's a proud moment for us as a country that we've landed on the moon. But some of these stocks have space and space stroke. Some of the entire technology-dominated stocks have gone up as if it's like going to be clear blue universe for them. So there are a lot of these pockets where you've got a lot of froth and you've got to be a bit careful, especially in the power space, smaller power names, than some of these so-called defense and space dominated stocks. But nothing beyond that in terms of a froth in the market which could be called as universal. Rupesh Shanki joins us, Vice President Institutional Research with Elara, and let's connect with him to discuss the fortunes of the power sector, and Hydrol is also ready to understand that what is happening in the power sector. Hari, let me start the discussion with you. In your understanding, why has the power demand shot up? Our understanding is that power demand is at a peak and there is a huge mismatch between what the demand in the evening is versus in the day.
Well, simple. The demand is rising as industry and commerce are thriving and is going to continue to rise. The immediate spike I would attribute is to the changes in the weather patterns. We've seen a lot of rainfall deficits happening in various parts of the country. And this is the result of climate change. But it will ultimately have to be adjusted as we understand our understanding of the change in weather patterns and climate change improve. If you notice, there have been certain parts of the world you had heat waves, which have been unprecedented. Other parts of India, for example, where a fantastic amount of rains and floods. Other parts of India where there was a huge amount of rain last month, and then in August, there's hardly anything. So the demand for power is rising because people are still trying to do some agriculture. So the agricultural pump set load is going up, air conditioning load is going up. And as it is, the industry itself is booming. So there's a tremendous demand increase all around. Coming to the second point, regarding peak power, if I remember, that's what you asked me. The consumption or the requirement of electricity in the evening peak hours is much more than, say, in the middle of the night. Whereas your generating stations typically run 24/7. So obviously, with the increase in demand coming up, evening peak rates are going to be higher. And that's normal and logical, and that's how market forces work. So there is going to be more and more tendency towards time of day metering as we go along across the country. And I think the government is doing a superb job in implementing schemes like smart meters, like time of day metering. They've also started a scheme called market coupling for the power exchanges. So we are coming to a stage where the consumer, even a household consumer in times to come, will be able to decide where to buy his power from and at what cost.
Rupesh, just want to get you in. I mean, there's no taking away from the fact, like Harry as well highlighted, that demand is robust. But does it justify what you're seeing on the power sector, on the bourses, the kind of up move that you've already seen in the stock prices? Or do you think this is just the beginning of it all?
Yeah, good morning. See, if you look at the re-rating which has happened in the last 6 to 9 months, the power stocks EV/EBITDA has gone up from around 7 EV/EBITDA multiple to now close to 10x. Look at the price to book value, which was trading at below 1 times price to book value, closely trading at 1.3 times price to book value. So certainly the valuation re-rating has happened because this sector where we have seen the cash flow visibility, the return on equity is based on CRC regulation. So these companies are generating close to 17% kind of ROE. And because of green transition, existing conventional players are now getting benefit. Earlier thought process that the unlisted renewable energy will get benefit, but now the conventional player like NTPC, NHPC, Torrent Power, JSW Energy are entering in a big way on the green transition. So they are getting multiple on the price to book value, and still it is a historical discount to what we have observed in 2005 to 2009. Even adjusted for return on equity, I think a valuation is re-rating has happened. And going ahead next 7-8 years, we can see the higher visibility on the growth, better capital allocation, and that will drive the re-rating ahead also.
I just wanted to get in your sense as well, Harry, in terms of the kind of steps that have been taken by the government, the incentives to the states that have been provided worth 1 lakh crore, etc. There have been changes in the electricity laws, etc. What's been your takeaway on the government's involvement?
I think it's super. You see, please understand, electricity is a fascinating subject. You can't see it, you can't feel it, you can't touch it, you can't smell it, you can't store it. Yet there's a market. Yet it's a part of, very much a part of our lives. And if India has to grow, the power requirements are going to go up. As we move towards the green transition, as my respected friend spoke, the challenge is coming up as well. And therefore a new market. For example, renewable energy is informed. You don't get it constantly. When the wind blows, you get power. When there's a solar, the sun is shining, you get power, etc., etc. You don't get the sun shining at night and so on. But there's a demand for power. So coming up with these kind of transitions also is creating a new market. For example, for forecasting. For example, you need to have grid management. You need to have all kinds of new, if I may use the word, AI-powered programs or issues which then allow you to anticipate how much will be the consumer demand. So this is going to then again generate a lot of interest and a lot of jobs, a lot of new markets, which will then come as a fallout of our green transition. There are challenges, of course. For example, the other day I spoke about smart meters. I think the challenges like cybersecurity and all of that, but I think we should be able to overcome those. So it's a very exciting time for us in India with our demand in growth and our economic growth going on the way it is. Nothing's going to happen without electricity. So it's very much like, breathing air. But yet nobody knows what electricity is, as I said. So it's very exciting. And I think in times to come, the government is taking a pretty practical approach in trying to, shall I say, issue guidelines and regulations on the way the industry should go. And he's right; it's a regulated industry, but then it also secures money for you. I mean, for example, a stock like Tata Power, we used to call it, a stock, for retirement. It's like a retirement stock. You will get your return. It's regulated, but it's secure and it's sure. Demand for power will remain, at least in my lifetime and yours, for sure. Thank you.
Rupesh, ultimately it comes down to a constituency which we are addressing, our viewers who want to invest in power stocks. And there is a whole range of ways in which you can invest in power stocks. You could bet on power utilities. You could bet on companies which are in smart meters. You could bet on finances like PFC, REC. You could bet on companies which essentially would be creating the solar network and would be creating the new renewable network. So in your understanding, Rupesh, which end of the power cycle should one go ahead as a good should invest in?
Definitely, you are right. The entire power system is getting benefit out of the investment that is happening over the next 7 to 8 years. So currently our installed capacity is 422 gigawatt and target is to close to 800 gigawatt by 2030. So close to 28 lakh crore kind of investment is there in the entire ecosystem, and all these power equipment companies are getting benefit out of that. Certainly, I think one interesting space that is in the limelight is the hydro space. So we have not seen the growth in the last 20 years. But certainly, we have seen many hydro companies like NHPC, HJVN has lined up for strong MOUs and under construction projects. So their regulated equity will go multifold from the current levels and still trading at close to 1 time price to book value and close to 19% ROE. So we'll bet definitely on the NHPC and HJVN from the current levels. And certainly the growth is very much high there in the next 8 to 10 years. In the large cap, I think NTPC still is available at attractive valuation. Certainly, we have seen some sort of re-rating happen. But if you look at the implied price to book value, it's just 1.1 times. And now they are getting benefit of a demand supply mismatch. Also, they are targeting around 60 gigawatt renewable energy. And the RTC benefit will be there for the conventional players because they are getting benefit of a low interest cost and a strong balance sheet. I think the market still we see upside left in the NTPC, considering the growth which is there visible, as well as the valuation they are trading at very, very reasonable levels. So these companies are there. Other companies like CESC is trading at below 1 times price to book value. They were not aggressive on the renewable energy front, but I think going ahead, they will also take some look at renewable energy in their portfolio. So certainly that stock looking good. And other ancillary companies like PFC, REC has a great disbursement opportunity going ahead. They are also trading at a very, very attractive valuation. Then we have other equipment players in the wind sector. The entire power system will get benefit, but will remain top on the NTPC, NHPC, CESC, and HJVN at this current valuation.
All right, gonna let you go on that note. Harry, appreciate your time, and Rupesh, thank you so much for joining in. So getting a 360-degree view on the overall power sector as well, the demand trends and what the outlook is from the government standpoint, some of the concerns and the positive triggers. Right back to stock-specific calls then, and let's find out what our chartists are picking out on Chartbusters. Naresh and Kunal right back with us, and Kunal, going to get in your call for the day. What's the view on your top banking recommendation?
Well, yes, Avan, it's Bandhan Bank, and the stock is going through a steady recovery over the last few weeks. Now, interesting bit for pattern for Bandhan Bank is the formation of this swing breakout. So the stock which went into a major correction from 270 levels start of the month of June towards a point when the stock was almost at that breaching levels of 200 mark. I think 206.7 was the low for Bandhan Bank over here. So it's managed to recuperate from the sell-off. What the stock has done in the process is retested this major trend line, which is around 230 to 32 mark for Bandhan Bank. And if you look at the short-term charts in process, the stock is forming a seemingly inverted head and shoulder pattern, with the stock confirming a breakout about this pattern yesterday on closing basis. With decent volumes, the stock has shown yesterday. So on the back of this, I would be looking out for bullish targets for Bandhan Bank over the near term, and we've also seen a round of short covering for many of the mid-cap private sector banking names. The pattern height is almost 20 odd rupees for Bandhan Bank, so we should be looking at a target potentially in the range of 250 to 260 for the stock over the very near term.
Right, okay. Naresh, what's the chart buster on your radar? Naresh, you got to unmute yourself.
Yeah. Chart is for Indian hotels. Now, after making that move towards 330 marks, it consolidated for 4-5 months, 6 months, and then gave a breakout about 330, went up to 400. Again, we've had a 3-4 month consolidation. And in that period, there have been 4 bottoms around that 378 to 382 mark. There have been 4 tops around 400 to 405 mark. From yesterday and today, we've seen a breakout above that levels. So a classical flag breakout done. And in this case, I would expect a move towards 450 to 480, stop loss to be kept at 390.
Okay, let's talk individual stocks as well. Kunal, what's on your stock radar?
So from the PSU pack, REC Limited is something which has been doing exceptionally well at 243-44 levels. Looks attractive for a target of another 5%. 255 on the upside is a target for REC Limited. Stop loss at 239. And the second would be a buy on RBL Bank, something which we discussed in the morning. Revising the targets from 240 to now 245 from a short-term play. And stop loss could be trailed to 229.
Right. Naresh, what about your stocks?
So first would be a buy on Bandhan Bank, good breakout seen here. Stop loss at 235, target price of 255. Second is a buy on LIC Housing, which is yet to break out above the mark, preempting it. Stop loss at 418, target price of 460.
All right, there you have it, all your Chartbuster recommendations. Thanks for that. Let's take a very quick break and we'll be right back with lots more market talk.